Welcome, curious minds, to another deep dive. Have you ever found yourself, wading through just stacks of reports, maybe research papers, or even just your own scribbled notes, thinking, oh, there has to be a quicker way, a more insightful way to get right to the heart of this?
Mm. Well, you are definitely in the right place today. Today, we're taking a deep dive into some really fascinating insights on what it fundamentally takes for the global economy to actually move forward, not just sort of limp along after a major worldwide crisis. We're talking about the real blueprints for recovery, the fundamental shifts in thinking that have to happen, and crucially, the kind of global collaboration that's absolutely required if we want to build a more resilient future. We've got some really illuminating material in front of us today. It stems from a key source that, while it looks closely at the Indian economy, it actually offers this profoundly global perspective on how to navigate these, let's face it, incredibly challenging times. So our mission today.
It's to unpack the shared consensus, that fundamental agreement for going forward that emerges, or maybe needs to emerge, when the big economies face a truly worldwide shakeup.
Yeah, and what's really fascinating here, maybe even a bit counterintuitive for some folks, is how strongly the source emphasizes a unified, a collective approach. It really pushes beyond just looking at things from one country's viewpoint. It urges us to really deeply understand the complex interdependencies, how everything connects that define our global financial system today. It's not just about patching things up in isolated corners, right? It's about fundamentally rethinking how we operate on an international scale, recognizing that a problem starting way over here can ripple out fast and sometimes severely affecting everyone, often in ways you just wouldn't expect.
Okay, right. Let's unpack this then. Let's discover the surprising, maybe hidden nuggets of wisdom within these pages. We'll look at everything from the very nature of economic recovery itself, what does it actually look like, to the often overlooked ethical side, the responsibilities of markets, and even the future roles of those big global institutions, like the IMF, the International Monetary Fund, and the WTO, the World Trade Organization. So get ready. You're going to gain some serious, maybe even paradigm-shifting insights that could really reshape how you think about our interconnected world and ultimately how we build a truly robust future together.
The post-crisis global landscape. Why consensus is key.
So the first big sort of overarching idea that really jumps out from our source material here is this absolute, almost non-negotiable necessity for global consensus, especially when a crisis has these worldwide implications. It's not just about, what interventions are made right in the heat of the moment, but also agreeing on that shared path forward, a unified vision, really, for long-term recovery. This isn't just some kind of nice-to-have feel-good sentiment, is it?
Oh, not at all. Not in the slightest. And this raises a really critical question. Why is consensus so vitally important? Especially when the crisis, ignores borders. The source makes it emphatically clear. It states that any crisis with global implications should and rightfully be driven by consensus across major economies. That's not just a polite suggestion. It's actually a stark warning. Because the alternative, these sort of fragmented go-it-alone approaches, they risk not just undermining, but actively destroying collective recovery efforts. I mean, just imagine for a second, right? In the middle of a huge global downturn, what if every major country just decided to do its own thing? Contradictory fiscal policies, maybe competitive currency devaluations, try to grab a trade advantage or throwing up new trade barriers in that kind of beggar thy neighbor fashion. It would create, immense chaos, right? Severe inefficiencies, but it would also definitely prolong the downturn and ultimately hinder recovery for absolutely everyone involved, even the nations trying to act alone. So the source really urges us, it pushes us to look at things from a truly global perspective rather than the country perspective. And what that means practically is understanding that something which might seem immediately beneficial for one nation in isolation, let's say a sudden sharp interest rate hike to control domestic inflation, could actually have really detrimental, destabilizing effects on the whole global system. And therefore, paradoxically, it could hurt that very nation in the long run, too. It really calls for a level of international statesmanship, I guess, collective foresight that prioritizes global well-being over those narrow, immediate nationalistic gains.
Okay, right. And a crucial part of actually building that consensus involves rigorously reviewing how effective those initial, damage control interventions actually were. We're talking about those immediate, often quite dramatic actions taken to, as the source puts it, arrest free falls in things like economic output shrinking rapidly or unemployment just skyrocketing. It's one thing to act fast fast, sure, but how do we genuinely assess if those emergency measures really worked? Did they truly prevent a deeper catastrophe? And what does that phrase surgical precision actually mean here?
Yeah, the challenge there is pretty complex, honestly. Evaluating whether these short-term sort of emergency measures genuinely prevented a deeper collapse. And this is the key part, extracting profound lessons from them. When the source talks about arresting free falls, it's talking about those really critical moments where economies are just spiraling downwards at an alarming rate. Think about stock markets plummeting day after day, businesses closing left and right, or unemployment rates hitting levels we haven't seen before. Those interventions, like massive government spending packages or central banks flooding financial markets with liquidity or emergency loan programs, they're designed specifically to put immediate floor under that free fall, to stabilize the patient, essentially, before they completely crash. So the assessment involves looking at whether those measures actually managed to stabilize the situation. Did they prevent widespread bankruptcies, keep essential services running, provide some kind of safety net for people and businesses right on the brink? But it's notoriously difficult, right? How do you prove a counterfactual? How can you know for sure what would have happened if you hadn't intervened? And this is where that surgical precision idea comes in. It's about identifying which specific interventions were the most effective, in what dosage and why, and then distinguishing them from measures that might have been less impactful or maybe even counterproductive. It's like a continuous feedback loop, learning from the immediate past to inform the longer-term, more structural future.
Now, here's where it gets really interesting and perhaps a bit sobering, especially for those of us hoping for a quick rebound. The source issues a pretty stark warning about the very nature of the recovery itself. It's predicted to be slow, long-term, and more importantly, uneven. That doesn't sound anything like the swift V-shaped bounce back everyone always hopes for after a shock, does it?
No, it absolutely does not. And what's particularly fascinating, I think, is the almost graphic way it's depicted. Not like the alphabet W, but U-shaped with the bottom more elongated. Now, that isn't just a casual metaphor. It paints this vivid, almost painful picture of a prolonged period with no sudden spurts of growth. Let's just break that down a bit. A V-shaped recovery, like you said, implies that sharp dip, then an equally sharp, strong rebound, back to normal, quickly. A W-shaped recovery suggests volatility, right? A sharp dip, a bit of a bounce, then another dip, and then finally recovery. So moments of maybe rapid but definitely unstable improvement. But a U-shaped recovery, especially one with an elongated bottom, well, that signifies something much more challenging. It means a significant sustained period of stagnation, or maybe at best, very, very slow, almost imperceptible growth right after that initial sharp decline. That bottom part can stretch for months, maybe even years, before any substantial recovery really starts to take hold. So for you, the listener, what this really means is a crucial need to manage expectations. To understand its structural changes, the kind that enable real, lasting recovery, they simply take time. It implies the economic landscape won't just snap back to how it was before the crisis. Instead, it'll slowly, gradually, and perhaps quite painfully adapt to a new, maybe often lower, equilibrium. That elongation really signifies that the pervasive structural effects of the crisis are going to linger, requiring immense patience and sustained coordinated effort across all sectors and indeed across nations. It really challenges that conventional wisdom that economies just naturally bounce back quickly after a shock. Instead, it points to deeper systemic issues that just take a long time to heal.
Policy paradigms, from short-term fixes to long-term reforms.
Okay, so if this recovery is going to be this drawn out, this uneven, with that U-shaped bottom potentially stretching way out into the horizon, what does that fundamentally mean for the role of things like those massive stimulus packages we saw, or government bailouts? Our source seems to have a very clear, almost prescriptive stance on them.
It certainly does. It emphasizes that these kinds of interventions are inherently short-term and withdrawable measures. And that's a critical distinction. They aren't meant to become permanent fixtures in the economic landscape or, a new normal for how governments operate day to day. The really critical insight here, I think, is that they should be replaced with sustained long-term reforms. This speaks to a fundamental and probably necessary shift in policy philosophy, moving away from just immediate emergency relief towards building foundational, enduring strength within the economy itself. Think of it like this, maybe. A stimulus package or a bailout is sort of like an adrenaline shot for a critically ill patient. It's absolutely vital for keeping them alive in the short term, stabilizing their immediate condition, arresting that free fall we just talked about. But to truly recover, that patient needs way more than just a quick fix, right? They need intensive care, maybe long-term rehabilitation, fundamental lifestyle changes, perhaps even some kind of reconstructive surgery to address the root causes of their illness. So these sustained long-term reforms that the source talks about, they would encompass a really wide range of policy shifts, things designed to improve a nation's underlying economic health and resilience. This could mean significant investments in education, skill development, modernizing infrastructure, streamlining regulations to foster innovation and entrepreneurship, actively promoting R&D. The goal is to make the economy inherently more dynamic, more competitive, and crucially less vulnerable to future shocks rather than just kind of propping it up artificially with temporary measures.
Right. So if these interventions are inherently short-term, what does this all mean for actually withdrawing them? Because you can't just pull the plug overnight, surely. That sounds like a recipe for a catastrophic relapse, almost guaranteeing that dreaded double-dip recession everyone fears.
Precisely. You've hit the nail on the head. The source advises that the withdrawal should be well thought out, staggered, and again, done collectively. Why collectively? Well, exactly as you intuited, because a hasty or uncoordinated withdrawal could facilitate fears of double-dip recession. Let's just imagine a scenario, okay? One major global economy, maybe facing some domestic political pressure, suddenly just cuts off its massive stimulus measures while other major economies keep theirs going full steam. That abrupt, uncoordinated action could send huge shockwaves through global markets. It could trigger significant capital flight from the withdrawing country, maybe leading to currency instability or creating severe trade imbalances that just ripple across borders. If, for instance, a large trading partner abruptly stops providing that domestic demand support, well, demand for goods from other nations might just plummet, potentially triggering economic contraction in those countries too. So this highlights the incredibly delicate balance that's required here. It's about preventing an over-reliance on that artificial government support, while simultaneously avoiding a really painful relapse back into crisis mode. It is absolutely a strategic, synchronized dance on a global stage. It requires crystal clear communication and meticulously coordinated timing among the major economies. The objective is really to ensure that the global financial system can gradually absorb the shock of reduced government intervention without crashing. Sort of like trying to safely land a massive aircraft, You don't just cut the engines. And the risk isn't just theoretical. History has shown us that missteps in tapering support can lead to serious market volatility. Think back to the 2013 taper tantrum, when just the announcement of a potential reduction in quantitative easing by the U.S. Federal Reserve sent massive tremors through global bond markets.
Yeah, I remember that. Okay, and despite this inherently slow and, let's face it, probably painful recovery, there's a really strong, almost defiant push in the source against a particular old habit, one that often emerges during tough economic times: neoprotectionism. The source explicitly states the way forward is not to restrict trade or return to neoprotectionism, but on the contrary, increase trade across countries as a way for economies to expand.
Yeah.
Now, that really challenges a lot of the immediate sort of self-protective instincts we might see surface in struggling nations, doesn't it? Why is multilateral trade seen as so crucial here, even when domestic pressures might be screaming for protection?
Yeah, if we connect this to the bigger picture, it's a direct and really powerful counterargument to those inward-looking, maybe even isolationist policies that tend to pop up during times of global stress. Neoprotectionism, imposing tariffs, quotas, other kinds of non-tariff barriers to international trade. It often arises from an understandable, yet often quite short-sighted desire to protect domestic industries and jobs during downturns. But the argument here is that this is a fundamentally self-defeating approach in a globally integrated world like ours. The source argues, really quite forcefully actually, that multilateral trade could have never ever been in economic history as relevant as it is today for revival of the economies. Wow. That suggests that openness and deep interconnectedness aren't just lofty ideals anymore. They are practical, immediate necessities for global economic resurrection. By increasing trade, economies can leverage their comparative advantages, specializing in what they do best and most efficiently. This allows them to access much larger global markets for their goods and services, which can lead to greater economies of scale, stimulate innovation through competition, and ultimately foster overall economic expansion that just wouldn't be possible if they were confined within their own domestic borders. For example, think about a country that's highly efficient at producing certain high-tech components. By trading these globally, it can achieve production volumes and cost efficiencies that would be totally impossible if it only focused on its home market. This specialization and trade lead to a more efficient allocation of global resources, often lower consumer prices, and a more robust overall economic system. So retreating into isolation through protectionism during a global recovery. That would be kind of like each member of a struggling sports team trying to play every single position themselves. It would only guarantee collective failure. It's really about leveraging collective strengths and stimulating demand on a global scale, rather than retreating into an economically detrimental isolation.
Reevaluating the market mechanism. More responsibility, not less market.
Okay, now here's an interesting and maybe slightly controversial angle. After a big crisis, there's often this immediate, almost knee-jerk reaction to blame the free market itself, right? We hear calls for heavy government intervention, sometimes even talk about dismantling market mechanisms altogether. But our source pushes back quite strongly against that narrative. It argues the crisis should not be seen as the collapse of the free market economy and larger role for the respective states in both acting as a producer or a regulator, both. So it's not saying the market is perfect, clearly, but it's definitely not advocating for a return to heavy state control either. What's the nuance here? What are they really getting at?
Yeah, what's really fascinating here is this nuanced, almost philosophical perspective they take. The source is unequivocally not advocating for abandoning the market mechanism entirely, or, bringing back the public sector or regulations in some overarching, heavy-handed way, like nationalizing industries or imposing stifling, all-encompassing controls. That's a crucial distinction. The source isn't saying free markets are inherently broken. Instead, the focus shifts dramatically. It shifts to internal market awareness and responsibility rather than simply slapping on more external top-down controls. It suggests that the market mechanism itself, the fundamental principles of supply and demand, competition, innovation, private enterprise, isn't flawed in its basic design. Rather, it's perhaps the way it's been practiced by some participants, or maybe the lack of internal ethical guardrails that need significant adjustment. So it's really a call for self-correction from within the market system itself, a deeper understanding and acceptance of the market's broader societal impact, rather than an indictment of its very existence. The core idea seems to be, let markets continue to be the primary dynamic driver of economic activity, but with a profoundly heightened sense of ethical and societal obligation coming from within the businesses and financial institutions themselves. It implies the problems were maybe less about the engine itself and more about the drivers and perhaps the lack of a proper ethical roadmap they were following.
Right. Okay, so it's not about a fundamental market failure necessarily, but more about a critical increase in awareness within the markets, a kind of recalibration of their internal compass, if you will. The source lists 4 incredibly important areas for this heightened awareness. Let's really unpack these because they seem to speak to the very soul of how business should be conducted, especially after a major shock.
Absolutely. The first point they make is, of their larger role and responsibility, which is freedom to do business, but not compromising on the moral ethics of businesses. Okay, what does that mean? It implies that profit generation, while obviously essential for business, must be meticulously balanced with a robust, unwavering ethical framework. It's about ensuring that the pursuit of business, no matter how ambitious it gets, doesn't lead down paths of morally questionable or even outright exploitative practices. This speaks to business understanding that their license to operate, their very permission to thrive in society, comes with an implicit social contract. So, for instance, prioritizing short-term financial gains through, say, deceptive marketing, or engaging in predatory lending, or exploiting labor in developing countries, that would be a clear, fundamental violation of this ethical responsibility. Conversely, investing in sustainable, environmentally friendly practices, ensuring fair wages and safe working conditions for employees, or contributing positively to community development, even if those things impact the immediate bottom line, would deeply align with it. It's really about building trust, ensuring long-term sustainability, and avoiding the kind of systemic abuses that ultimately contribute to crises in the first place.
And then there's that fascinating but really crucial distinction they draw between healthy ambition and destructive excess. The desire for expansion and growth can be passions of businesses, but not greed. This really hammers home a point about the underlying motivation, doesn't it? Is it healthy, sustainable growth driven by innovation and genuine market demand? Or is it this unchecked avarice that could ultimately destabilize the entire system?
Exactly. Greed, in this specific context, seems to refer to an insatiable, sort of disproportionate desire for wealth or power that actively disregards ethical boundaries, societal welfare, or even long-term economic stability. This unchecked, relentless pursuit of just more,
often manifests as excessive risk-taking, maybe opaque and complex financial practices designed to hide true liabilities, or exploiting regulatory loopholes just because you can. The source is making a subtle, but I think profoundly important point here. A healthy, vibrant economy absolutely needs dynamic businesses. Businesses driven by a passion for innovation, for expanding into new markets, for creating real value, and for genuinely serving customers. That kind of passion fuels progress. But when that legitimate passion morphs into unbridled greed, well, it can distort incentives, encourage reckless behavior, create speculative bubbles that inevitably burst, and ultimately lead to the kind of systemic failures and widespread economic pain we've unfortunately witnessed in past crises. It's about recognizing these powerful psychological drivers within the system that, if left totally unchecked, can fundamentally undermine market integrity and the trust it relies on. Third, the source highlights that businesses also have societal and responsibilities to their nation. Now, this significantly broadens the scope of accountability beyond just shareholders or immediate customers. It directly connects corporate behavior to the broader national well-being. This can encompass a whole range of actions, contributing responsibly to local economies through employment and using local supply chains, maybe supporting national priorities like innovation or infrastructure development, or ensuring the well-being and ongoing development of their own workforce. For example, a business that prioritizes short-term profit by heavily polluting local environments, or by ruthlessly outsourcing jobs without any regard for the social and economic impact on its community. That would clearly be failing in this societal responsibility. Conversely, a company that actively invests in local job creation, supports education initiatives, or participates meaningfully in community development projects would be fulfilling it. It's about seeing businesses not just as profit machines, but as integral parts of the national fabric, with a vested interest in its overall health and prosperity.
And finally, a truly fundamental, almost foundational principle they state. The interest of the people can and should never be compromised.
Oh.
Wow. That is a powerful, unequivocal statement. It elevates the welfare of the general populace, basically everyone, above all other considerations in business practices. So for you, the listener, this sounds like a profound call for businesses everywhere to remember their most foundational purpose, serving society.
Indeed. This principle really underpins the entire framework of ethical awareness that the source is advocating for. It means that business decisions, right from the initial stages of product development and how things are priced, to labor practices, to environmental impact, all of it must ultimately serve the collective good, not just private gain. If a business decision, no matter how profitable it might seem on paper, ends up compromising public health, jeopardizing safety, undermining economic security for large segments of the population, or restricting access to essential services, then according to this principle, it is inherently flawed and unacceptable. It's a powerful ethical mandate, isn't it? It compels businesses to consider the wider, often downstream implications of their actions, and to operate with an unwavering sense of public trust and accountability. Recognizing that their own long-term success is intrinsically, inextricably linked to the well-being and prosperity of the population they serve, it really calls for a paradigm shift away from profit at all costs towards something more like profit with purpose.
Strengthening global governance and cooperation.
Okay, so moving beyond the sort of internal ethical compass of individual market players, our source points to some absolute critical shifts that are needed at the government and institutional level too. There's a distinct call for greater intergovernment monetary cooperation and also at the apex central bank level. Sounds like we need a truly united front, not just politically, but financially and monetarily between the major nations. Is that the idea?
Yeah, I think that's exactly the idea. If we connect this to the bigger picture, it suggests that global economic stability, particularly after a widespread crisis hits everyone, really hinges on absolutely seamless coordination, not just within nations, but fundamentally between them. In our increasingly interconnected global economy, isolated, uncoordinated actions by individual central banks or finance ministries can have severe, often unintended negative consequences for other nations. It can trigger a kind of domino effect. For example, if one major central bank suddenly dramatically hikes interest rates to fight its own domestic inflation, but does it without any coordination or clear communication with others, well, that could trigger massive capital flight from other countries, potentially leading to currency instability, increased borrowing costs, and maybe even sparking financial crises elsewhere. So it's really about central banks and finance ministries speaking a common language, sharing critical information in real time, and acting in concert, rather than just operating in isolation or, worse, in direct competition with each other. This cooperation could involve concrete mechanisms like, say, currency swap lines between central banks to provide emergency liquidity in times of stress, or coordinating interest rate policies to avoid those disruptive capital flows we mentioned, or even joint interventions in currency markets during times of extreme volatility just to maintain global financial stability. It's really about moving from a patchwork of national policies towards a more synchronized global orchestra where each major player understands its part and plays in harmony with the others for the sake of the whole system.
Right. And even broader than that specific monetary cooperation, the source talks about the need for better global supervision and not regulations over the global financial system. Okay. Now, that feels like a very fine yet incredibly important distinction: supervision versus regulation. What's the precise difference there, and why does that distinction matter so much for building a resilient global financial system?
Yeah, what's truly fascinating here is that emphasis on proactive oversight and transparency without necessarily imposing rigid, heavy-handed, prescriptive rules that might, inadvertently stifle innovation or just become quickly outdated. Let's try to clarify that distinction. Regulation often implies a detailed, comprehensive set of rules that dictate exactly how financial institutions must operate. Think of things like very specific capital ratios, strict leverage limits, or detailed reporting frequencies. Now, while those are necessary in some areas, that approach can sometimes lead to a kind of inflexible, one-size-fits-all model that struggles to adapt to rapid market changes. Or worse, it can even incentivize institutions to spend their energy finding clever loopholes rather than managing risk effectively. Supervision, on the other hand, implies a more flexible, dynamic, and forward-looking approach. It focuses more on ongoing monitoring, assessing risks as they emerge in real time, and ensuring that the institutions themselves are responsibly managing those risks internally. It's sort of like empowering financial actors to self-regulate, but within a framework of rigorous, watchful oversight. Think of it more like a proactive, continuous health checkup for the system, rather than just waiting for an illness to strike before prescribing a treatment. This potentially lighter touch focuses on establishing early warning systems, fostering robust information sharing across borders about emerging risks like new complex financial products, and cultivating a collective awareness of systemic vulnerabilities. It's seen as maybe better than imposing overly prescriptive regulations that might prove inflexible in a dynamic global environment or accidentally stifle beneficial innovation. It's really about empowering institutions to maintain discipline from within, backed by vigilant oversight, rather than trying to micromanage every single transaction from the outside. For instance, a supervisor might identify a new complex financial product and instead of immediately banning it, work with institutions to understand its risks properly and help them develop appropriate internal controls first.
Okay, that distinction makes sense. And this crucial idea of supervision over regulation then leads directly into the call for good collective leadership that provides good governance and also to lead both at the same time. Who exactly are these leaders the source is pointing to? And what specifically does this collective leadership entail in practice? It sounds quite demanding.
Well, the source is actually quite specific here. It identifies the governments of the US, EU, Japan, India, and China as having a larger role for resurrection of the global economies as fundamental and primary objective. These are quite clearly some of the largest and most influential economies on the planet. Their combined economic weight, their huge financial markets, and their significant political influence give them a unique capacity and, the source argues, a profound responsibility to shape global policy and drive collective action, especially after a crisis. So it really highlights their disproportionate influence and therefore their responsibility in shaping the global economic trajectory going forward. Collective leadership in this context seems to imply that these specific nations must consciously move beyond just their narrow national interests or immediate domestic political squabbles. They need to collaboratively address these pervasive global economic challenges. It's really an acknowledgement that their own individual prosperity and stability are deeply, inextricably intertwined with overall global stability. You can't really have one without the other in the long run. So this means jointly setting priorities, coordinating major policy responses, like stimulus withdrawal we talked about, and actively fostering an environment of trust and shared responsibility that can genuinely guide the global recovery effort. It's fundamentally about building a common agenda for shared prosperity rather than just competing against each other, especially when the global system itself is fragile.
And that is, as you said, a pretty tall order, isn't it? I mean, what does this really mean for their priorities? It sounds like they'd need to put quite a lot aside, perhaps even some deep-seated political differences, to truly achieve this kind of collective action.
It certainly does. The source puts it very bluntly. It means economics dominating politics and setting aside political differences. Now, this is arguably one of the most profound and maybe most challenging statements in the entire analysis. It suggests that in times of profound global crisis, the absolute imperative of economic recovery and collective prosperity should, by necessity, supersede things like geopolitical squabbles, ideological disagreements, or even historical grievances that might otherwise divide these powerful nations. It argues for a really pragmatic, results-oriented approach where shared economic prosperity becomes the unifying, overriding goal. So, for example, even if there are ongoing trade disputes or differing stances on human rights or competing geopolitical ambitions, these nations would still need to actively collaborate on critical economic issues. Things like coordinating the withdrawal of stimulus measures effectively, jointly strengthening global financial supervision, or ensuring the free flow of essential trade and investment continues. It's a direct call for a pragmatic focus on the shared economic benefit over short-term political gains or digging in on deep-seated historical grievances. This requires, frankly, immense political will and a clear recognition that global economic health isn't just some desirable outcome. It's actually a fundamental prerequisite for any nation's long-term stability and security, including their own. The crisis itself, in this view, almost becomes the ultimate unifier, forcing a focus on what genuinely secures collective survival and future prosperity for everyone.
Structural reforms for financial system resilience.
Okay, so moving beyond those broader principles of cooperation and awareness, our source really drills down into some incredibly specific structural issues, things that absolutely need addressing, it argues, to build greater strength to the global financial system. Let's dive into these crucial elements, and maybe we can start with a term that many of our listeners might recognize, even if the details are a bit fuzzy: Basel III.
Indeed. First up, there's the critical implementation of the Basel III Accord. This comes from the Basel Committee on Banking Supervision, or BCBS, which operates as part of the Bank for International Settlements, the BIS. Now, just to briefly clarify for anyone unfamiliar, the BIS is essentially a bank for the world central banks. It facilitates international monetary and financial cooperation. And the BCBS is the primary global standard setter for banking regulation. Basel III itself is a comprehensive set of international banking reforms. It was developed directly in response to the 2008 global financial crisis, and it's aimed squarely at strengthening the regulation, the supervision, and crucially the risk management of banks all around the world. It's fundamentally designed to prevent a repeat of the systemic failures we saw back then.
Okay, right. So what exactly should Basel III aim for, practically speaking? What are its core objectives in truly strengthening banks, beyond just being another regulatory checklist? And you mentioned capital infusion earlier. What does that mean here?
Basel III has several really key aims to make banks more resilient, to make them less likely to fail or need rescuing. Firstly, it aims for better risk assessment capabilities of global banks. This means helping banks more accurately identify, measure, and then manage their exposures to all sorts of financial risks. Whether that's credit risk, the risk borrowers won't pay back loans, or market risk, the risk of losses from fluctuating market prices, or operational risk, the risk of losses from internal failures, fraud, or external events. It's about moving beyond simplistic models to get a real handle on the complex web of risks a modern bank faces. Secondly, it requires banks to explicitly define risk appetite. They need to clearly outline how much risk they are willing to take on in pursuit of profits. This ensures they have a conscious, board-approved strategy for risk-taking, rather than just blindly chasing short-term gains without thinking about the potential downsides. It formalizes their tolerance for risk. And crucially, perhaps most importantly, it mandates that banks have sufficient own funds. Essentially, this means holding significantly more and higher quality capital, especially things like common equity, which is the best shock absorber to absorb potential losses from unexpected economic shocks or adverse events. The goal is for banks to handle losses themselves, rather than relying on government bailouts paid for by taxpayers, which is largely what happened in 2008. This core objective ensures banks have a much more robust financial cushion, and that's why the source explicitly states that strengthening would require capital infusion. It means banks will need to raise more equity capital from investors, or perhaps retain a larger portion of their earnings instead of paying them out as dividends, specifically to bolster these financial cushions. It's about making banks genuinely capable of absorbing losses internally, so they can weather economic storms without collapsing and taking the broader financial system down with them.
Got it. And it's definitely not a rush job, right? The source stresses that sufficient time should be given, like in the previous accords, for smooth transition of banks in different countries to Basel III. Why is that phased, patient approach so incredibly important when you're rolling out such a critical global standard?
Yet what's really important here is the recognition that global implementation of frameworks this complex, this impactful, simply cannot be rushed without potentially causing unintended and maybe even severe disruptions along the way. Basel III involves really significant, often intricate changes to how banks calculate their capital needs, how they manage their liquidity, how they report their financial health. Rushing its implementation could lead to adverse consequences. For instance, you could get an undesirable credit crunch if banks suddenly become overly cautious and sharply curtail lending to businesses and consumers while they adjust. Or you could see widespread operational disruptions as they scramble to adapt all their internal systems and processes. So the phased approach acknowledges the immense diversity of financial systems and operational capacities of banks all around the world. A huge, sophisticated multinational bank might be able to adapt relatively quickly, but a smaller regional bank, maybe in a developing economy, might need substantially more time, more resources, perhaps even technical assistance to implement these complex changes effectively. Advocating for a smooth, pragmatic transition ensures stability during the transition period, rather than causing disruption. It allows banks to gradually adjust their balance sheets and risk management systems without jeopardizing their core functions, or critically, undermining the broader economic recovery that is itself so dependent on having a stable financial system. It's a very pragmatic recognition that stability really trumps speed when you're implementing these kinds of major systemic changes.
Makes sense. Okay, next up, the IMF's role. The International Monetary Fund. The source argues its role needs fundamental restructuring. It says it's about prevention, not just cure. That sounds like a pretty significant and proactive shift from its traditional perception as, the firefighter of the global economy, the one that rushes in after the fire starts.
Yes, it absolutely is. It's a profound shift, both philosophically and operationally. The source states the IMF would need to be restructured to play the role of prevention rather than providing cure. Traditionally, as you say, the IMF has been seen primarily as the lender of last resort. It steps in with emergency loans, often attached to strict policy conditions, but usually after a financial crisis has already erupted in a member country, often when things are already looking pretty dire. This new mandate implies a shift towards much more proactive monitoring, towards issuing early warnings based on comprehensive surveillance of economies, and providing preemptive policy advice specifically designed to avoid crises altogether, rather than just intervening with rescue packages after the damage is already done. So for instance, what might this look like in practice? It could involve the IMF conducting more frequent and maybe more rigorous assessments of member countries' economic vulnerabilities, looking for potential weak spots before they break. It could mean providing more tailored policy recommendations before problems escalate out of control, or perhaps facilitating crucial international dialogues on emerging systemic risks, whether those risks are coming from large sovereign debt burdens, potential asset bubbles forming, or the complex interconnectedness of major financial institutions. And the source also adds they will have to play a larger role in global supervision to provide the oversight mechanism to the global financial system. So this significantly expands their mandate, making them a central, proactive player in identifying and mitigating systemic risks right across borders. The goal is ensuring that potential hotspots within the global financial system are identified and addressed before they become widespread wildfires that could engulf the entire system.
Okay, so a much more forward-looking IMF. Now, what about the Financial Stability Board, FSB? What's needed there to make it more effective in this new landscape of enhanced global supervision?
Well, for the FSB, the source states there should be greater clarity in the proposed Financial Stability Board, FSB, in terms of its role. The FSB, remember, was created in the immediate aftermath of the 2008 financial crisis. It's a key international body designed to coordinate efforts among national financial authorities like central banks and regulators and the international standard-setting bodies like the BCBS we just discussed. However, the argument here is that its exact mandate, its operational scope, and maybe its precise relationship with other global bodies sometimes need refinement to maximize its effectiveness and avoid, duplication of effort or confusion about who's responsible for what. So this calls for a really precise, unambiguous definition of what the FSB is specifically responsible for monitoring and coordinating, and how exactly it will execute that role to help prevent future crises. Clarity is key. Additionally, and this is a subtle but I think quite important point, the source calls to provide independence to the monetary authorities in different countries to pursue independent monetary policies. Now, this acknowledges the fundamental need for national central banks like the Federal Reserve in the U.S. or the Bank of England, or the Reserve Bank of India to retain a degree of autonomy in their own decision-making, particularly regarding domestic interest rates and money supply, even within a broader framework of global supervision and cooperation. While that global coordination among central banks is absolutely vital for managing cross-border spillovers, individual countries often have unique domestic economic conditions, right? Specific inflation rates, different unemployment levels, varying growth needs, and these often require tailored monetary responses. Respecting that independence ensures that domestic policies remain appropriate for local needs, while still contributing to overall global stability through transparent communication and a shared understanding of the international impacts of those policies. It's a really delicate balancing act between global harmony and necessary national sovereignty in policymaking.
Right, that balance seems critical. Okay, moving now to the really important issue of ethics, which we touched on earlier regarding businesses. The source calls for evolving a global code of ethics. What would that actually entail in practical terms? And why is this ethical underpinning seen as so critically important now, especially after a crisis that many felt had strong moral dimensions to it?
Yeah, this idea of a global code of ethics aims to provide broad financial discipline. Now, this isn't likely about micromanaging every single transaction worldwide or trying to impose some single universal moral code on vastly diverse cultures. That would be impractical, probably impossible. Rather, it seems to be about establishing overarching, widely accepted principles of responsible and ethical behavior that should guide financial institutions globally. It's based on the recognition that a lack of ethical conduct or just turning a blind eye can quickly translate into systemic financial instability that hurts everyone. The source gives a couple of powerful examples to illustrate what this might mean. First, prudential norms of lending. We talked about this a bit before. It simply means responsible and cautious lending practices. In practice, it means banks shouldn't just lend indiscriminately to borrowers who clearly can't afford to repay or fund highly speculative ventures without sufficient collateral or a clear, viable business case. It's about ensuring that loans are based on a sound, objective financial assessment of the borrower's actual capacity and willingness to repay, not just driven by aggressive growth targets or the desire to earn short-term fees. You just have to think back to the subprime mortgage crisis in 2008, where a severe breakdown of exactly these prudential lending norms led directly to that devastating cascade of defaults. Second example, exposure norms for banks in different economies to follow. This means setting clear, prudent limits on how much risk banks can take on with single entities like one big corporation or specific industries, or even entire countries. This is all about preventing an excessive concentration of risk in one place. If a bank has way too much exposure to, say, the commercial real estate sector, and that sector experiences a sudden downturn, it could destabilize the entire bank. Similarly, if a bank has lent far too much money to one single large corporate entity, the failure of that one company could potentially bring down the bank.
So these norms, these ethical guidelines, are really about instilling a pervasive culture of caution, transparency, and deep responsibility right across the global financial industry. Recognizing that a lack of ethical conduct or just plain reckless risk-taking can quickly translate into widespread, devastating systemic financial instability that affects absolutely everyone, far beyond the institutions that made the initial bad decisions.
Okay, that makes the need very clear. Finally then, the WTO, the World Trade Organization. How does it fit into this crucial global recovery framework, especially when we've talked so much about the need to avoid protectionism and actively embrace multilateral trade? It seems like its role is more vital than ever based on this analysis.
You're absolutely right. The source declares in a really quite powerful statement that the need for a transparent and fair multilateral trading platform like the WTO can never be more than now. Wow. That powerfully underlines its renewed, maybe even enhanced importance in the post-crisis world. In a world struggling to emerge from a major shock, where individual nations might be sorely tempted to look inward to raise trade barriers out of a sense of perceived self-preservation, the World Trade Organization serves as the absolutely essential forum, the place for ensuring open, fair, and crucially rules-based trade continues. The source continues, saying it's in the interest of all economies to put their heads together in evolving a consensus at WTO, not only for their own interest, but for also long-term sustainability of the global economy. This just reiterates the vital, almost indispensable role of multilateral trade as a cornerstone for sustainable global growth and long-term stability. It deeply emphasizes collaboration over narrow individual gain. Without a strong, functional WTO, trade disputes could easily escalate into damaging trade wars.
Protectionist barriers could quickly proliferate, choking off trade flows. And the very benefits of increased global trade we discussed earlier, greater efficiency, more innovation, expanded markets, lower prices, would be severely jeopardized. So it's really about securing a robust framework for collective prosperity, achieved through fair, predictable, and transparent exchange between nations, ensuring that trade remains a lubricant for recovery rather than becoming yet another source of global conflict and instability.
So after all that, what does this all mean for you listening right now? We've taken a really comprehensive deep dive today into what a genuine global consensus for going forward actually looks like, especially in the challenging aftermath of a major crisis. From that sober reality of a potentially slow, elongated U-shaped recovery to the non-negotiable need for sustained long-term reforms and those critical ethical responsibilities that markets simply must embrace. Well, it seems crystal clear that the path to real resilience, to sustainable growth, and lasting stability is paved with deep cooperation, not with insular isolation.
Yeah, we've explored how critical it seems to be for those major economies, the US, EU, Japan, India, China, to maybe counterintuitively prioritize economics over politics sometimes, setting aside differences for the greater global good. And we've seen how vital institutions like the IMF and the WTO need to fundamentally evolve, becoming more preventative, more transparent, and acting as fair oversight bodies for the whole system. This isn't just about dry economic policy, is it? It's really about building a global financial system that is not only robust enough to withstand future shocks, but one that is also morally accountable, one that genuinely learns from past mistakes and actively works to build a more sustainable, maybe even more equitable future for everyone, everywhere.
And here's where it gets really interesting, I think. That idea that multilateral trade is actually more relevant now than ever before in economic history. That really challenges many of the protectionist narratives we hear so often today, doesn't it? It strongly suggests that true, enduring strength and prosperity come not from closing borders and retreating inward, but from actively fostering deep, interconnected global trade relationships based on fairness and trust. It's a powerful argument for continued openness.
And this perhaps raises an important question for you, the listener, to really ponder as you go about your week. If global economic stability is so deeply reliant on things like international consensus, on ethical practices from businesses large and small, and on open, fair trade between nations, what critical role do individual citizens and consumers like yourself actually play in upholding these principles? How do your daily economic choices, where you shop, what you buy, the companies you support, how do they contribute to, or maybe detract from, this larger vision? How does your informed engagement with these complex global issues actually factor into building this resilient, ethical, and interconnected global future we've been talking about? Because your actions, however small they might seem, are definitely part of this massive, intricate global system.
That is indeed a powerful thought to chew on. Thank you so much for joining us on this deep dive into the future of the global economy. Until next time, keep that curiosity alive.